Hey everyone, I'm Vincent Andriaki, VP of Business Development at ISG Transportation, back to share some updates on the North American LTL and full truckload markets. Today, we're diving into what we saw from March 2026 and what you can do to protect your supply chains. As we move through the first quarter of 2026, freight demand has remained steady, but seasonally soft with volumes showing only modest shifts from recent patterns. However, the main story this month has been the sharp surge in diesel prices across North America. Diesel climbed dramatically in a short period, with US national averages rising quickly toward or above $5 a gallon, and Canadian prices rising substantially to around $1.80 to $1.90 Canadian per liter. This fuel shock is hitting carriers hard after years of operating on razor-thin margins. With fuel accounting for a significant portion of operating costs, many are now aggressively passing on higher fuel surcharges. The result is sustained upward pressure on overall rates, with year-over-year increases of 15 to 30%, as well as additional short-term spikes directly related to the diesel surcharge. This dynamic affects lanes across the board. So let's dive into what we're seeing across Canada, cross-border, and the US. The Canadian trucking market is more balanced than the US, but rising diesel prices are causing a significant cost pressure and volatility. Domestic truckload tender rejection rates remain around 4 to 7%. Tightness is caused by equipment and driver constraints. Retail, parcel, and industrial activity in Ontario and Quebec and British Columbia contribute to steady LTL volumes. Full truckload volumes are stabilizing, but higher diesel prices are causing carriers to adjust operations and surcharges. Overall, rates are higher year over year, narrowing the spot to contract gap and creating upward momentum. Key lanes like Calgary to Edmonton and Vancouver to Toronto have seen improved transit as winter eases, but fuel has driven cost pressures, which add friction. Here's one key takeaway. As costs rise, consider dedicated intermodal solutions across Canada and consolidate your freight whenever possible. Ship more and your cost per skid will decrease. Cross-border freight continues to show uneven dynamics. In terms of demand and capacity, northbound, which is US to Canada, appears to remain stable with tender rejection rates between 7 to 9%. And this is likely due to the equipment requirements for heater units and TDG certified drivers. Southbound, Canada to the US, has eased somewhat as automotive and parts volumes decrease. Rejection rates are at 3 to 5%, but this is increasing. Rising diesel is worsening repositioning challenges in the United States. When it comes to LTL, northbound is relatively steady, whereas southbound is softer. When it comes to full truckloads, diesel prices are causing increased surcharges, particularly on long-haul routes. When it comes to rates, northbound is steady to slightly higher, whereas southbound is competitive in a few areas, driven by rapid adjustments in fuel surcharges. Overall, the spot contract gap is narrowing. Toronto to Chicago and Windsor to Detroit sectors continue to see increasing delays, southbound, but northbound lanes into Montreal and Edmonton remain stable despite some fuel volatility. Here's one key takeaway for shippers. With diesel prices rising, prioritize carriers with balanced north and southbound operations to avoid repositioning surcharges. Create a fuel program that your carriers can live with because it will highlight substantial savings as diesel costs fall. The truckload market in the United States is tightening fast, driven by diesel price increase after years of low margins. National tender rejection rates remain very high, with dry van rates around 13%, reefers around 18 to 19%, and flatbeds approaching 25%. The fuel shock is forcing marginal carriers to park equipment, keeping capacity thin, even as the winter weather improves. LTL volumes remain soft but are improving as freight shifts from truckload. Spot rates for full truckload are firm and year-over-year increases are significant. Rates year-over-year see increases of 15 to 30% in many segments, which narrows the spot to contract gap. Expect single-digit to low double-digit price hikes for 2026 renewals. Midwest and long-haul corridors are seeing the most pressure, with reefer and flatbed particularly strained by fuel costs and weather recovery. Here's one key takeaway for shippers. Focus on proactive contract renewals with fuel protections. Diversify your carrier base and consolidate loads where feasible to control your per unit costs. Rising diesel prices in North America have become the key driver in the freight market for March 2026. Lean carrier operations and equipment and drivers have also started to contribute to delays increasing surcharges, and upward pressure on prices. The market remains uneven and highly sensitive to disruptions, with clear ripple effects on southbound lanes and major corridors. Diesel prices are increasing, and with operations being lean and driver supply being tight from FMCSA non-domiciled CDL restrictions and changes to Canada's temporary foreign worker program, tightness could be longer than expected. As spring arrives, produce and construction season will add pressure in key segments. Plan for significant headwinds ahead. Prioritize and develop strong relationships with carriers to navigate fuel volatility. Utilize flexible surcharges and consolidate shipments where possible. If you want a more in-depth analysis of the current market and how it applies to your business, give me or any of our reps a shout. Thanks for watching, and we'll see you next month.